want to turn to SureVest CEO Rob Luna, Hercules Investment CEO James McDonald, and Kingsview Wealth Management CIO, Fox Business contributor Scott Martin for more. Gentlemen, lots to deal with in the market today. You can say we're on Trump health watch, stimulus watch, election watch, in economy watch. I want to begin, of course, with stimulus because all their chatter has gotten much more positive today, although the markets are moving up and down based on every single headline, particularly from Nancy Pelosi. Now, we also know President Trump contracting the virus underscores the unknowns and the vulnerabilities with everything else in this economy. But let me just start with you, Rob, about the stimulus part of this, which is dominating the markets every move right now.
Yeah, I think that's the hugest part of what we're dealing with right now with the market, Charles, especially, I think the big game changer is a few days ago, we saw Disney come out laying off 28,000 people. But when American came out and said, hey, we're getting ready to lay off thousands of people unless we can get a stimulus package, that put a lot of pressure on getting a deal done. And all of a sudden, we started to see some of these talks picked up because I don't think either side wants to be responsible for something like that. So the stimulus is really the big issue. I think, the COVID issue, obviously, with President Trump is a health-related issue, but that's a red herring in terms of the market. The stimulus is what we need to get the market moving back up.
Yeah, there's no doubt that the initial reaction to President Trump being positive with COVID-19 was devastating. Most of the action in the pre-market, pre-opening session was down, but we have clawed back. And Scott, to Rob's point, you've got the airlines who directly threw a salvo at Congress saying, hey, we won't lay off 30,000 people if you help us. Disney took a direct shot at California. Yeah, we got to lay off 28,000 people because you've got the economy shut down. So corporate America taking their fight to lawmakers and the market's responding.
Yeah, the ball is definitely in the lawmakers' court. And I think the companies are playing it right, Charles, because they're playing it straight up. And here's the thing. Just remember, though, guys, as we've been fighting over this stimulus now for weeks or months, even probably really internally, the markets have seen better and better economic data coming out, whether it's consumer confidence, consumer spending numbers, jobs data. So it's not so much that we absolutely desperately need a stimulus. I think the markets would like it. But there's also a good economic backdrop going on there, too, that I think the markets can rest their laurels on if we don't get a package soon.
James, I agree that overwhelmingly the data has been good, but there are enough yellow flags. Consumer income down 2.7%. The jobs report this morning, the headline number wasn't as good as we thought it would be. Consumers had the dip in the savings to the tune of $700 billion. So they're spending. They're keeping this economy going. But you got to wonder if they can keep it going without any additional help. So we've got the V-shaped thing going. There's no doubt about that. Where do you stand on what needs to be done next?
It's important to understand these data have shifted. We saw a massive rally in March, and it's been going up and up and up. August was a record, but that came to an end in September. And so it's important to understand the inflection point is here. We've all been talking about the incredible recovery, whether it's equity market prices or simply just the trajectory of the economy. This has come to a pause, and we believe here at Hercules it's come to an end. Permanent layoffs increased by almost 10% just in the past week, 345,000 permanent layoffs to 3.8 million now. We have to understand that equity market prices here are overvalued. If we look at the price to earnings ratio or even the cyclically adjusted price to earnings ratio, we are still 10% higher than pre-COVID levels. The CAPE ratio stands now at 30.92. That's the second highest earnings, valuation behind the dot-com bubble.
Here's the thing, though, Rob. I don't know about you, and I can tell James is not going to be in this boat. I plan on taking some positions. If we don't hear anything from Congress, at 3:45, I'm going to buy 3 or 4 stocks because I think we'll get some news. The question, though, is where do we go? Because this session began with profit taking. So those super-duper hot mega growth names, ironically, are the weakest in the market today. It's the defensive stocks that are holding up. It's now the time to maybe go there for real.
Yeah, I think so. And, the issue about PE ratios and all that, if you look at historics, that's right. But look, we've got 50 basis points on the 10-year. When you've got things like the dividend aristocrats, which are rallying today because you're getting 200 basis points over a 10-year, you can't really look at that old news. That's not going to get it done. So I think you stick to that barbell, you stick to the dividend names. They're going to pay you to wait. But you also have to get back to the names where if we are dealing with COVID, the ServiceNows, CrowdStrike, Zoom, they're going to perform. But they're also the names that are leading us out to the new economy as well, Charles.
Right. And in general speak, right, and just, less markety speak, essentially you're saying these large corporations that pay out big-time dividends and have done it for a long time are so much more attractive because you can't get anything with a CD or bonds anymore. And that gives these stocks support. To that point, Scott, with this work from home, that is the one niche, obviously, that's doing extraordinarily well today. Peloton earlier today hit an all-time high. Are you looking at these names? Are they worth chasing? Because you're definitely chasing them here.
Yeah, they're too high for my blood, Charles. But they're interesting, though, when they pull back, which they do, because they get to these levels and then they pull back about 10%. Now, they're very quick pullbacks, so you got to be ready to hit the trigger. But the reality is this, the funny thing about the ones you mentioned, as well as some of the other, let's say, work-from-home stocks that are out there in the cloud side, those are kind of defensive names now, if you will. So if we get into, say, slower economic growth, if we get into more shutdowns, you can actually buy these names to probably help protect your portfolio. And then just going forward, too, guys, also take a look at financials here. Financials are performing very well. I've talked about them on the show before. Yeah. They have nice dividends attached to them as well, as Rob pointed out, with the 10-year so low as far as yield.
I will admit, I'm not a fan of financials, but early in the session, J.P. Morgan and then later Goldman Sachs, they're flashing on my screen. I don't know what the flash means because there have been a lot of false alarms, but a lot of people believe there's value there. James, I'm not sure if you're a value guy or not, but energy made a big reversal today. I'm not sure what's driving that. Some folks are going into names like the financials, which have underperformed. If you are skeptical or concerned, how does someone build in some insurance for their portfolio here?
It's a great question. Purely to protect a portfolio, we like the valuation of only one asset class, and that's volatility. Volatility right now is underpriced where it should be. We think there's about 50 to 70% upside between now and the election. But going back to the comment about where we put money right now in stocks, value investing does not work in this current 2020 environment like it may have worked coming out of the dot-com situation, or Mike, it may have worked out of coming 2008. If you study all the style investing tactics for 2020, where we've had 13 of the 20 largest daily point losses in history, 5-year earnings growth projections is the only way you can make money in this environment if this year continues. And we've said that the Fed has indicated it will not change interest rates for 36 months. And so we've got to buy growth stories. And it is the cloud, but not just the cloud. Beyond Meat is one that has nothing to do with technology. There are some innovators out there. They're going to grow. But right now we're putting money into volatility.
All right, volatility. Hold on to your hat, and you'll make a lot of money. James, Rob, Scott, we really needed you guys today. Thank you very much. Appreciate it.